Hey, it's Rick here for Wednesday, January the 4th. You gotta love it when you tape for 15 minutes and then realize at the end of it that you didn't have your microphone on. So here's round two. Starting with the model where we always do. Minor change today. The S&P got above the 8-day moving average, but everything else is still red. So as we'll see in the charts, not a lot of change. So here's the S&P, and we're still in this, what I call a chop zone after that 8% decline over the last 5, 6 days, a couple of weeks ago. We're still chopping around. This actually shows up better in MarketSmith on a shorter time frame. So this is a 60-minute chart of the S&P going back to the middle of November. And you can see we're in this range here for about a month and a bit, going nowhere, and then it broke out of the range to the downside, and then it's been chopping in this range now for the better part of since just before Christmas. And so now this is going to resolve itself either to the upside, in which case it's going to come into this overhead resistance up here, or resolve to the downside, in which case we can go a lot further down. So we're just in a holding pattern here for next few days until this resolves itself. The QQQ is a similar story, although a little weaker than the S&P. QQQs were dragged down by Microsoft today, which was down about 5%. Not sure why, probably a downgrade of some sort. And this brings up an interesting point. Microsoft is also in the Dow Jones. And if you pull up the Dow Jones, it actually was up on the day, despite Microsoft being down 5%. And so this is why I tend to encourage people, if you're going to buy stocks that are just going to mirror the market, in other words, they're going to go up just as much as the market and generally speaking go down with the market, then why take the single stock risk of something bad happening to that one stock? And you're much better off to buy an index so that you actually, it's a lot safer. You get the same upside, but the downside is limited. So the fact that Microsoft was down 5% today didn't affect the Dow Jones at all. Had virtually no effect on the S&P 500, but did drag down NASDAQ because it's such a huge component of the NASDAQ index. The areas that are showing more strength is the mid caps. And you can see from this chart, although the 200-day moving average is still moving down, price today is trying to get above it. So it's the only one of the major indexes that I follow that is in this category, other than the Dow Jones, which I tend to ignore because it's only 30 stocks. So the Dow Jones has been outperforming. But again, as I say, it's only the 30 biggest companies. So in times of safety, institutions sort of flock to these companies. So when things get better, they'll bail out of those and then get back into the smaller caps. So that's my take on that. I have 9 open positions right now, which is a lot, but it only represents 34% of our accounts. So all of the positions are pretty light. So I'm still almost 70% cash. And I'm going to mark up the charts a lot more than I have in the past. I found in my year-end exercise of reviewing my past trades that marking up these charts is a really valuable tool. In fact, I looked at a number of them and said, what the crap was I doing? Why was I taking these trades? And why didn't I stay with these longer? And so on and so forth. So it was a really eye-opening exercise for me. So I'm going to spend, it takes a bit of time, but I'll have more time because I'm only planning on taking about half the number of trades this year that I did last year. That was one of my faults last year, was over trading, taking way too many trades, way too many marginal trades. So this year I vowed to focus on the best of the best, and be much more selective and pay much more attention to them. So this first one is ALNY, a pharmaceutical company. It's trading at all-time high. It had this move here up 63% in basically a couple of days last August. And it only pulled back about a third of that, and then has been drifting higher and higher and getting back to the all-time high area where it is meeting some overhead resistance or some supply. But once it chews through that, this could really rip. So, and this is holding up very nicely in a weak market. So hanging on to this one. Hasn't given me much gain, but hasn't lost me anything yet. Another biotech company, Catalyst Pharmaceuticals, similar story. It made a great move here. It went from $6 to almost $16 over the span of about a month or so, gave back a little bit of it, and now is just quietly resting right near the highs as it absorbs a bunch of supply. And when that supply dries up, this one could move quite rapidly. And again, this is going up, but on very low volume. So there's not a lot of selling going on. And when it did get some selling here back on December the 19th, it immediately got bought up at the 50-day moving average. And so it's appears to have some strong institutional support there. So up just a tiny bit on this one, but it's looking good. A new one, GILD. Again, nice big move up on, I think this was on earnings in end of October. Wedged higher, and now it's just pulled back a little bit and is forming what could be a bit of a cup and handle pattern. I did reduce this by half today because it's just looking a little weak, and this is a big behemoth, $100 billion company, and in the end, I don't think it's going to move all that much. So I just wanted to trim the size a little bit. HIBB is doing beautifully. Again, it's just right above a rising 200-day moving average. I entered yesterday right at the 8 moving average. It's up about, I think it gained about 3% today. No, actually, one time it was up 6% today. So I took half of this off. I took a quarter off at a 3-to-1 profit ratio, and another quarter at 4-to-1. My stop is now a break even. So worst that's going to happen is I'm going to bag a decent profit on this one, and I'm going to ride this for as long as it allows me to. So nice trade there so far. Steel company, focused on aerospace. Again, as you can see on the chart, these pullbacks are getting progressively shallower, and now is just bouncing around right near its all-time high. And in a better market, I already have a full position on this one, and in a better market, I would be overweight this one. But it's just this kind of a market. I'm going to be content with what I have. I've already raised my stop to break even. I haven't sold any yet, so I'm going to ride this one as long as it will continue to give me profit. Logitech International, bought this a couple of days ago, added to it yesterday when it broke above this base here. It opened with a gap up this morning of about 3%, but it faded during the day. So it just tells me this was more retail buying than institutional. So I'm going to cut this. I sold a quarter of it, and I'm going to give this a very short leash because until I really see that it's institutions that are going to drive this, I'm going to don't want to risk anything. So I've already raised my stop to break even. And you can see this is a declining 200-day moving average, which would normally I would completely shy away from. So it just tells me, I scroll this back, there's a fair bit of overhead resistance here, but that overhead resistance is about $10 away from today, where and about $12 away from my entry. So it gives me lots of profit if it gets up to that area. But I don't expect this one's going to be a huge winner. Actually bought a Canadian stock today, which is highly unusual. Saputo cheese, and it was doing nothing so far. If it doesn't move, I'm just going to cut it. I have a very tight stop, and it's only a half position, so not a lot of risk with this one, at least dollar risk. So if it works, it works. If it doesn't, get cut. And then TITN had a great gap up on earnings. Gave back more of it than I would like to see. I would like to see this level off at about half of this gain, but nevertheless, it is starting to come back. But again, I've got a tight leash on this one. So I've got a bit of profit in this. My original stop is down here at $37. I've now raised that. I cut half the stop is at $38.50 and the other half at $37. So again, this kind of a market, I would, I'm just looking to reduce risk as much as possible. And the last is United Rentals, another big company, basing beautifully along the all-time high. Made a nice move today. Again, in a stronger market, I'd be all over this one. I'd be adding to it, maybe even go overweight because it's got great fundamentals. But I'm just going to stick with what I've got. Stop has already been raised to just slightly below my entry price. And so again, we're going to ride this as far as it will give me, or it will stop us out. So that's it for now. More than I probably wanted to get into, but anyway, we'll talk to you again tomorrow.